Right, enhancing characteristics, enhancing characteristics. So these are the follow-ons really, the follow-ons really from the qualitative characteristics, from the qualitative characteristics. So what we have here are comparability, verifiability, timeliness, and understandability, if you like, that enable, if you like, or enhance the usefulness of information. So we've already established the fact that relevance, if you like, and faithful representation are fundamental characteristics. And then we have these other, if you like, events. And these, of course, help us. So what are we trying to say in terms of comparability? We've been talking about, we've always had comparability very much central to what we do, if you like, as in our, through our period of studying accounting. It's central. When we prepare our accounts, we always represent the previous year as well as our current year, if you like. So we're constantly comparing to enable, and of course, classification and all these events are very important to ensure, to enable comparability. That's what we're really trying to do here. So users must be able to compare the financial statements of an entity over time to identify trends in the financial information and performance. Compare the financial statements of different entities. We want to be able to do that as well. So having a set of standards that enable this comparison is important, if you like. The fact that the more we're all converging towards one set of, if you like, financial reporting standards will enable that comparison, if you like, to evaluate their relative financial performance and financial positions. For this to be the case, there must be consistency and, of course, disclosure. So an important implication of comparability is that users are informed, of course, that we want to ensure, because accounting policies, we could be talking, if you like, historical versus revaluation in terms of property, or even classification. So for example, people might be recognizing depreciation within, if you like, cost of sales. Some people might be recognizing depreciation within, if you like, expenses. And so the important thing, if you like, is to enable the good comparison from one year, if you like, to the next. So there we are. So important is the users are informed of the accounting policies employed in the preparation of financial statements, and if there are any changes, we need to make sure that they are uniform and then they work across both years. Compliance with accounting standards, if you like, including the disclosure of the accounting policies, help to achieve comparability. So if at least you're aware of what those differences are and the standards, if you like, then of course you can enable, that will enable comparison. So users, again, because users wish to compare the financial position and the performance and the change in the financial position, it is important the financial position statements show corresponding information, like I said already, for the corresponding periods. So for at least for the last year, that you must show those periods. So again, really what we're really doing here is that verification, just verifiability. Has this been checked? Direct verification means verifying an amount through direct observation. So for example, through actual counting cash, we're literally saying that figure is, that's the figure it is, that's what it is, and we trust it. I guess there's an element of the fact that some audit work has been done on the figures, if you like, if you like, and sticking with the same sort of policy. I mean, policy again here, when we talk about policy, we're talking about first in, first out, for example, versus, if you like, whatever AVCO. And what we're really asking for here is you stick with the same policy year on year, whatever it is that you are doing, whatever it is that you are doing. Timeliness, of course. So timeliness means having information available to decision makers in time to be able to use to make their decisions. And of course, generally, the older the information is, the less useful it is. And so timeliness, of course, connects very, very nicely, of course, to understandability, because we want them to be able to, if you like, have a good understanding of what's going on. We want them to have at least some basal understanding of business and economic activity, if you like, so they can actually, and we don't want to be complicating the information as well too much. There's been a lot of talk about minimizing the amount of material that goes into disclosures to what is relevant, if you like, so that people don't just look at disclosures and just think, oh, there's just so much here, we can't be bothered. So you can see really here it's about ensuring that whoever's using these accounts can actually understand what's going on. So what we're going to look at next are the elements of financial statements. So the elements of financial statements, here we are. So an asset, if you like, what is an asset? An asset is a present economic resource controlled by the entity as a result of past events, if you like. And that's, I think, a critical point here. This question of talking about something that is controlled. I think I've highlighted it. Definitely, we're talking about something that is controlled by the entity, if you like, as a result of past events. Now you can see here that again, the standard itself doesn't highlight the fact that there must be future economic benefit flowing, but here it just, you can see it defines an economic resource as one that gives you that is a right that has the potential to produce economic benefit. You can see it's sort of saying it has the right, it has the potential to. So it just means that now the framework is sort of saying sometimes we have certain assets that aren't actively bringing in economic benefit, but it has the right to, or it can, if you like. So in order to prevent any confusion, the definition just talks about it just saying, listen, it's just a present economic resource controlled by the entity as a result of past events. It doesn't actually say that anymore, but when you look at the definition of what a present economic resource is, or an economic resource is, you see that potential or that right as opposed to it actively doing it. A liability, present obligation to transfer economic resources as a result of past events. A perfect example here is a loan. You've taken out a loan in the past. You have an obligation to pay it, if you like, in over time and in the future. Okay, so equity interest, of course, is really the residual of A minus L. So whatever is left, if you like, after deducting all the liabilities, what belongs to the owners of this business. Income, when we talk about income, I mean, income really is, again, the fact that you have taken a product of sorts and you have been able to make more, right? You have taken, say, inventory, you've bought inventory and you've been able to add some value to it and you've been able to receive more, if you like, in that, if you like, into your business. So really income is the increase, if you like, in assets, if you like, first of all. But in exactly the same way, you might have been able to take a situation, say a liability, for example, and you have been able to adapt it and therefore release it to actually have less of the liability, for example. So typically we see income, of course, naturally in the idea of if you like, of assets, but you can also consider it to be the decrease in the liability, of course, that results in definitely overall, because I minus E, yes, of course, all ends up getting added to C, to capital. So we see really an increase in equity as a result of that difference. Yeah, so again, really, we're just really connecting it to the statement of financial position. That's what's really happening here with this definition. But ultimately, and expenses are literally what we're having here is we are having a decrease in asset with expenses. We're buying goods, so we're, if you like, we have a fall in money because we have bought an expense, for example. So your bank goes down as a result of you buying the expense, or you have an increase in your liability as a result of you having your expense. And that's really what we're talking about here, really. Either you have A going down or L going up. So, and in basically this eventually, I mean, the increase in E, I minus E leads in itself to the fall in C. I mean, E is a natural tendency to reduce the value of equity, doesn't it? So some other key points in terms of here are to do with, first of all, it's to do with recognition. Items are only recognized in the financial statements if they meet the definition of one of the elements. However, not all items meeting these definitions are recognized. So elements are recognized if recognition provides users with useful financial information, if you like. Yes, elements are recognized if recognition provides users with useful financial information. So really this question of recognition means that a couple of things here, that recognition must provide relevant information and a faithful representation of the asset or liability, if you like, and resulting income, expenses, or equity movements. Really. So typically, again, like I say, so it must either be income, expense, asset, liability. That's when we recognize these things. Yeah, so again, relevant information, faithful representation of that. And you will see here that we start to talk about, this is where we start to play out this question of the probability of flow of income or economic resource. We recognize events when there is I guess it seems obvious, when there is a certainty or if you like, a probability, which is of course probability due to provisions, for example, but certainty, we actually recognize the asset or recognize the liability. So for example, you've sold some goods on credit, you have a legal document called a trade receivable invoice to recognize, yes, of course, certainty, if you like, within the law. As with trade payables, you have a liability, you have bought some goods, you will pay. So there's certainty here. Probability, we do with provisions. If there's a strong probability, we recognize the provision. The accruals concept allows us to recognize the provision. But of course, we might have, so for example, yeah, this is a good one here where we talk about contingent liabilities, where we're not sure, it's not probable that there will be some economic outflow. So we don't recognize it. What we do is we disclose. So recognition is very much about what is the chance of this thing happening? Is it material? Like I said, relevance. Is it material? What is the probability of it happening? Can we faithfully represent it? Can we get a figure for it? If we can do all those things, so recognition of an element might not provide a faithful representation if there's a high degree of measurement and certainty. So it's all about, can we get this right? Can we get a figure on it? Can we measure that figure reliably? And what's the probability of that happening? Right, let's finish recognition, then we'll stop this video. So if an asset or liability is not recognized, like I said, disclosures may be required to ensure that users fully understand the reporting entity's economic transactions and the implication that these may have on future earnings and future cash flows. And I think that's all very critical here. So and there we are. Right, great stuff. So I think what we'll do is we'll stop the video there and we'll carry on the fourth video in the next part in the next video. Right. So I actually think, I only had 4 more slides. So what I'm just going to do is attach this bit on to the video and complete this really here and just see if I can tag this on. I'm going to try. So I talked about recognition. So let's just quickly finish off. So this is sort of this idea of this financial position approach, really, and that's kind of the approach we're taking. The fact really is that income is an increase in an asset or decrease in the liability. And expense is an increase in a liability or decrease in an asset. And that just really operates, if you like, from the sort of the accounting equation, as income and expenses are therefore recognized on the basis of changes in the assets and liabilities. This is known as a financial position approach to recognition, if you like. Right. So derecognition is just, there never really has been anything on derecognition. There's derecognition within standards, within individual standards, but they've now decided to talk a little about derecognition. It's really saying that if you no longer have control over a certain event and you no longer have if you're no longer in control of it, you're not using it anymore, then you should, if you like, derecognize it. So derecognition is the removal of some or all of an asset from the statement of financial position. And this normally occurs when the entity loses control of the asset, has no present obligation for the liability. Accounting for derecognition should faithfully represent the changes in an entity's net assets as well as its liabilities retained. So what do we do? This is achieved by derecognizing any transfer. So anything that you don't have this asset anymore, let's derecognize. Derecognize any transferred, expired, or consumed component, and recognize a gain or loss on the above, and recognize any retained component. And that's really the point here. The key point is sometimes an entity will think, if you like, might have borrowed money on an asset. So sometimes an entity might have appeared to have transferred an asset or liability. However, derecognition would not be appropriate if exposure to variations in the element's economic benefits is retained. So the key point here is if you're still using the asset, if you like, you're still using it, it's still very much under your control, but you're technically or legally sold it. Well, you haven't really sold it. You've just used that asset as collateral. So for example, an entity sells a building for 2 million and retains the right to buy it back for 3 million in 5 years' time. Interesting. And at the date, the building has a fair value of 7 million. So you will, and says property prices are expected to rise. So 100% you will exercise that right. So in effect, you haven't sold this building. You've just taken out a loan of 2 million using the asset as security. So what am I saying? The entity in this case does not derecognize the building because you haven't lost control, and this will be recognized as a loan liability. And that really is the end of that chapter.